Over the past decade, ProducePay has established itself as one of the early agri-fintech companies to really gain traction with farmers.
When you're a fruit and vegetable farmer, traditional financiers, they'll give you cash in exchange of using your land as collateral, machinery as collateral, or equipment. But none of them, or very few of them, will allow you to leverage what is likely your single biggest asset, which is the future crop.
Founder Pablo Borquez says the company has seen the inefficiencies in the market and now has set their sights on also becoming the largest produce trader in the world, leveraging their network and technology.
It's actually pretty easy for us to provide a better value, even when we clip 10%, because today farmers lose anywhere from 40 to 60% of the actual retail purchase price, given the amount of inefficiency borne by waste and by non-value intermediaries.
He hopes the company can build on its fast growth to create a consistent year-round supply of produce with less waste and more value back to farmers.
I am excited about building the first multi-annual preset price contract with a major retailer in the history, at least of the Western world.
ProducePay founder Pablo Borquez on today's Future of Agriculture podcast. Well, hello, fellow Ag Nerd. Thank you so much for joining me for another episode of the Future of Agriculture. My name is Tim Hamrich, and every week you and I get to hear from the farmers, founders, innovators, investors, the people shaping the future of the ag industry. I'm very pleased that this quarter of the Future of Agriculture podcast is brought to you by our quarterly presenting sponsor, which is SwapMaps. Because when you know more, you grow more. SwapMaps variable rate technology helps you understand the why of field variability and how to better manage it. Understanding soils is the core of a successful fertility program, and SwapMaps allows you to map, measure, and better manage your soils using data that accurately delineates areas with similar fertilizer response characteristics. Turn your data into actionable value with SwapMaps. They're your trusted variable rate provider on millions of acres currently with a 98% retention rate. SwapMaps, they do variable rate right. Learn more at swapmaps.com. Book a consultation or just check out more information. That's swapmaps.com. But you don't have to take just my word for it. Listen to Tyler Kessler talk about how SwapMaps opened his eyes to the potential of variable rate and how it's worked for him as both a farmer and agronomy consultant working in southern Saskatchewan.
I started being introduced into SwapMaps, and that really was the turning point of where I believed it started to make sense for me. I could see it started making sense for the clients. And it was the base layer of if you're actually dealing with physical properties. You're not dealing with just yield maps. You're not dealing with imagery to try and, market a scalable business. In our case, we've got 99% retention. Anyone that has tried it continues to increase their acres and they want more.
Again, that website is just swapmaps.com if you'd like to learn more yourself. And thank you so much to SwapMaps for supporting Ag Innovation and the Future of Agriculture podcast. All right, now to our featured conversation today with ProducePay founder Pablo Borquez. Born and raised to a fourth-generation farming family in Mexico, Pablo brings over 20 years of experience in the fresh produce industry. And after growing up on the family farm, which is a premier supplier of fresh asparagus and grapes to the U.S. and Canada, Pablo went to work for the Giumarra Companies, managing grower relations in Argentina, Chile, Uruguay, and the U.S. He returned to the family farm as chief financial officer, then went to complete his MBA at Cornell, which is where the idea for ProducePay was started, founded, and launched. And after several years of growing that company, just this past year, ProducePay announced that longtime board member and advisor Patrick McCullough would take over as CEO from Pablo, and Pablo moved into the role of executive director of the board. But as you're going to hear in this interview, he is just as energized as ever about their mission and their future. We talk about the challenges of the produce trade and why there's still so much waste and so many intermediaries involved in the process, why he thinks that ProducePay is in a position to create a better model, what role financial technology has in their ability to pull all of this off, how interest rates and investor sentiment impact companies like ProducePay, and how this transition has been for him from founder to CEO to now board director. There's a lot to this story, quite a bit of nuance. I hope we did a good job of covering it and making it clear for all of you. But a good place to start is just acknowledging that we all want to walk into a store and see fresh quality produce that we can buy off the shelf every single time we show up, whether it's in season locally or not. For that to happen, there's a whole lot of people involved around the world and, unfortunately, a whole lot of waste along the way. ProducePay may have started as a way to better capitalize farmers around the world, but now they're focused on how they can help those farmers manage price risk. The guy who started it all, of course, is today's guest, Pablo Borquez.
My farming family, traditional. They moved to kind of northwest Mexico, during the big ag reform there. A lot of the case studies and a lot of the new varieties of wheat and corn that were born out of the Green Revolution were actually practiced and tested in the Yaqui Valley, which is where my family comes from. Over the years, my family moved to fruits and vegetables, particularly my grandfather. Started with grapes, and then my father, much more so, he delved primarily in asparagus, but historically over time also into grapes, green beans, melons, celery, broccoli, cauliflower, and a bunch of stuff. Always loved the industry, was always very pulled by it, very, very fascinated by it, and but not always necessarily because of the right reasons. One of the reasons I was fascinated by the industry is because I saw how inefficient it was, how much price fluctuation existed between any given week, how much a lack of supply would dry supermarkets of any given commodity, and those quote unquote inefficiencies are what ultimately drew me in to do more in the industry.
Yeah, talk more about that, because one of the ways you described ProducePay, I think, was like a digital trader of produce. And I know my background's in trading commodities, and one of the things we love as a trader is volatility. So are you trying to solve for the volatility, or are you trying to capitalize on it, or kind of a little bit of both?
We're actually trying to solve it. And by solve it, I mean we're trying to mitigate it. It doesn't mean you don't have volatility, but it means you try to eliminate as much as possible the peaks and valleys that happen across the industry. Let me give you a specific example. Let's say you go to the supermarket every week and your family gets now used to buying, let's say, pears at a certain price. And your kid loves pears, right? And they fit well within your budget. But then for some reason, pears are now 4 times as expensive because there's a lack of supply at some point in time. Well, now you have to make a very hard decision. You either deprive your child of the pears he's now become so, enthralled with, which is denying him of a healthy habit, or you pay 3 times as much going out of budget. An issue that is particularly or even more hard in this day and age where the economy is, in an iffy place. So that's what we're trying to eliminate. We're trying to make it so that whatever fruits and vegetables your family wants to get used to at an affordable price that you find fits within your budget, you can keep doing so at any given time. So we don't love volatility. One of the reasons we don't love volatility is because if you look at the evolution of grain markets, which were much more efficient because they can be stored, really they have become the underlying base of the world's diet because they've now become accessible. You can budget to a certain price, you can grow to a certain price, you can manage to a certain price. When you can either make 50% one year or lose 100% of your margin the other year, that makes it very hard for companies to scale, to structure efficiently, to build properly for growth. And that makes the inefficient outcome of it make produce just that much more expensive than it needs to be. When you can create an efficient market where you know how much will be consumed at what price and you grow accordingly to that, you create efficiencies that ultimately bring back the food waste into the supply chain, making the average of fruits and vegetables cheaper for all.
So short of, making them all shelf stable, which, as you said, kind of aids in why grains are so efficient in terms of markets. What can you do to create a more efficient market, or what have you done with ProducePay to create a more efficient produce market?
Thank you for circling back on that. The perishable nature of fruits and vegetables is why this $1.5 trillion industry is the last of the behemoth industries to remain institutionalized or digitized or essentially become efficient, right? The only way you can do it is by creating a predictable parity of supply and demand, or as we call it internally, a predictable commerce platform. So let me give you an example. When I mentioned earlier to you that we source from 14 countries, one of the reasons we do this is because we want to ensure stability of supply. That is, if you are used to buying strawberries or cherries, that you can buy them year round. You can only do that when you have enough geographical diversification, because there's only one winter, one summer, one fall, one spring at any given part of the year, but there's two of them if you use both hemispheres. And you can even stretch those seasons longer if you move above and below the equator, right? That's what ProducePay is doing. We're ultimately making sure that you will always have blueberries or strawberries or cherries or whatever by ultimately sourcing from different places that achieve that. So what we do then is we then go to the biggest supermarkets in the world, the places where you buy your fruits and vegetables, and we say, hey, why don't you tell me what the price points are at which your clients are comfortable buying this commodity year round? And they say, you know what? If they can get a small basket of strawberries for $1.50, our clients would buy 5 of them for their family or 4 of them every week, which would boost berry consumption, which would boost healthy trends, right? But we need those to be $1.50 at any given time of the year. So then we would go out, we would optimize, and we would actually create that stability, and we would create, call it, the hedging instruments to allow that to happen. So the supermarket and correspondingly the client would achieve that. And that is what we do. Now you're asking, well, if some people are selling at $5, why would they ever sell at $1.50? The real truth here, Tim, is that a huge amount of fruits and vegetables that are shipped to consumers are lost. 40% or 4 out of every 10 pieces of fruit that are shipped to you, and that is after they've been harvested and cleaned and packed and filtered, those are wasted. So you lose 4 out of every 6. So imagine if we could change the industry from a push strategy, that is, you ship and you wait for it to get consumed, to a pull strategy where you know years ahead how much is going to be contracted out, so you grow it exactly at those demands and those specs. If you could reinsert that food waste back into the industry, the ability to lower prices without affecting the farmer is there, right? There's also a huge amount of intermediarism. There's 3 to 4 what we call non-value additive intermediaries that ultimately handle the fruit and add their margin simply because the fruit doesn't know where it needs to go. If we can create this pull industry, as we call it ourselves, and this predictable commerce platform, we can eliminate these 2 to 3 non-value additive middlemen. We can eliminate this 40% of food waste, and that alone allows us to reach both a stable return for the farmer and a very affordable, stable, predictable price for the consumer that allows them to then budget their own groceries accordingly to have fruits and vegetables of their choice every week.
Right. And I know this is just one part of your business, but the way we're describing this part of your business, it sounds like something that, you know, brokers have been trying to do for a long time and to varying degrees have done, which is, you know, let's create some more predictable revenue for the farm, predictable supply for the buyers, and smooth everything out. So what is ProducePay bringing that enables this to happen, whereas others who might just use, you know, a Rolodex and a telephone, you know, can't quite put together?
First of all, I'm going to maybe challenge one of the points you say there. Brokers don't have the incentive to create price stability because brokers are normally people that are in the middle. And when you are in what we call a non-value additive intermediary, you benefit from a discrepancy in information. You benefit from the noise because it allows you to tag on 10, 20, 30% much easier. Only when markets are efficient that these brokers have to become very competitive and have to really squeeze their margins to the value they add. So to give you a point is, these non-value additive intermediaries or these non-value additive brokers exist because of this variability.
You're right. Sorry. Broker, in the grain sense, broker takes no ownership, and so they just bring buyers and sellers together. I realize in the produce sense, it's actually a different role. It is more what we would call a reseller. But yeah, no, point made. You're right.
So to your point as to how we can do it, it's scale. We spend the first 8-9 years of our company achieving what we call critical mass. Now, we're the fastest growing company in the Western Hemisphere. In the next 2 years, we expect to become the largest produce trader in the world. And like that is what we bring, right? It's the only way you can provide stability is by having 52-week supply. No regional broker or no regional agent that connects farmers and sellers can achieve that because, again, the moment you can't store fruits and vegetables means that you can only sell them in the weeks after they're harvested. So the only way to achieve that is to having a very large, multinational, geographically diversified presence, and that comes with scale. A scale that very few companies have achieved, let alone ones that are focused like we are on using that scale specifically and for the sole purpose of achieving price stability, right? A lot of them do it because they want to have commodity year round and they want to be able to have a brand name that they can do that, but not specifically because they want to use that to create price stability that will ultimately benefit the consumers. ProducePay's mission is to become the largest sustainable trader in fruits and vegetables in the world. And the only way we can achieve the latter, the sustainable part, is by creating efficiency so that margins can become what's most efficient for the farmer and the consumer, which means eliminating the non-value added intermediaries, which means creating stability of price. That is, the moment you can publish prices in an index and say the future price of grapes will be, call it $25 for the next 3 months, and then it'll be $30 for the next year because we know that there's not enough plantings to supply that, then everybody has that information and everybody's working with that same information. So you create a lot of efficiency that ultimately is shared or borne specifically by the end consumer, i.e. you and I when we go to the supermarket, and the farmer.
And keeping on the same situation, you mentioned hedging strategies. So obviously there's no futures market for melons.
Not yet. We're creating that ourselves.
Okay. All right. Well, so how, short of like selling to me and immediately turning around and buying from farmers, how could you possibly hedge a market like that?
You do it because most crops can only be grown in certain parts. So the answer is yes. Like when you have enough, and it's ambitious, but this is literally what we're doing and what we've accomplished in some key commodities now, like berries, like grapes, like avocados, like broccoli and cauliflowers. When you have enough of a presence in enough places, you can understand what the supply existing today is and what the supply potential in the next future will be, right? So like we know, for example, that if you can produce like, 100 million cases of grapes in a particular region, the odds you can produce 200 in the next 2 years are very low because you have to take at least a few years to plant those and to grow those. So there is an overall limitation as to how much supply could be. So then let's say that we close the futures for grapes at $30 to go back to the example. And I'm using examples that are somewhat close to reality of what we're doing. And you lock it in now. And then the next year, like during the season comes and all the grapes were $50. So all the retailers that didn't lock in the price, like they're now buying much higher than their competitors, right? So they're going to come to us and be like, you know what? I want to have a futures year now in the next year because I don't want to be in this situation again. We would go out and contract that. Now the next retailer comes and he tries to do the same, but now there's less available grapes to do that with, right? So now the futures are no longer 30, it's 35. And then the same keeps happening. So that's literally how futures market work today in a grand scheme of things. Now, when we have the ability to assess the overall global supply and demand in a large scale, which we already do in 3 continents today for a huge part of consumers, you can start gauging those contracts in, I wouldn't call it real time, but in a very large global supply. Because again, you can't produce probably any fruit or vegetable in real time. There's a production curve and a time to production that comes to terms. You can bake that into the volatility of the future and the forward and then lock prices in. And those that come later will ultimately buy at a higher or lower price based on how supply and demand balance each other over time.
When I mentioned the word broker earlier, you correctly talked about how it's a little bit different because they benefit based on price discrepancies. I imagine then the way ProducePay gets paid is much more transparent. So how do you get paid for your role in these types of transactions?
ProducePay does 2 things to ultimately ensure a proper trade. One is we invest directly in the farms that we work with. That's why I mentioned to you that we had medium-sized farms that we have helped become now big farms or like semi-behemoths of industry because we've invested multiple, if not dozens of millions of dollars into helping them do that, right? ProducePay shares the risk of farming with the farmers, but by doing so, we also secure offtake and we secure price. So our ability to both share in the risk with the farmer, And then simultaneously, our ability to get contracts at the price points that the farmer desires is how we earn a percentage. So the more successful I am at getting price points that you want, the more I get paid. So we have a revenue sharing model for every, call it, service that we provide. If I share in the farming risk with you and that's all I do, and you don't want us involved in selling your fruits and vegetables, then I take a small clip. But if you actually want me to go out there and you want me to get you contracts to do that, and you want me to secure the supply routes or logistics routes, I take another clip, right? But eventually the farmer has to weigh in whether working with me, despite these clips, is better off than do it himself. But again, because there is a lot of non-value additive intermediarism already in the industry and a lot of food waste, it's actually pretty easy for us to provide a better value, even when we clip 10%, because today farmers lose anywhere from 40 to 60% of the actual retail purchase price, given the amount of inefficiency borne by waste and by non-value intermediaries. So today we charge anywhere from 2% to, call it, 12%. And that depends purely on how much a farmer wants us to do. But what I'm very happy to say is that because of the inefficiency that we are eliminating, farmers tend to want us to do more than less, because we can actually provide the very real quantifiable value as to what their net return is. And it is always higher than what they can get on their own.
So the 2% to 12%, that's being charged to the farmer. Can you give us a sense of the different types of value that they're getting in return? Obviously, access to these markets. That's number one. What other types of value might they be getting from this arrangement?
Well, capital. Like, for example, ProducePay is the only, or at least one of the very few, I mean, that's how we made our name, entities that can actually underwrite perishable biomass risk. And what I mean by that is, when you're a fruit and vegetable farmer, traditional financiers, they'll give you cash in exchange of using your land as collateral, in exchange of using machinery as collateral or equipment. But none of them, or very few of them, will actually give you or allow you to leverage what is likely your single biggest asset, which is the future crop, right? So ProducePay actually goes into your farm and we say, yep, I can reasonably assess that these vines, these trees will produce X amount of dollars. And I believe in so much because I can see the tree or I can see the vine and the inherent value in it, that I will allow you to leverage that future crop by X%. And because it is such a huge amount of collateral, call it latent collateral, we allow the farmers to expand their capabilities significantly, so that like farmers that work with us will immediately be able to boost their production, or at least their cash ability to manage a larger production by a double-digit percentage, because they now have a much bigger pocket that allows them to invest in those crops.
All right. Yeah. So this is getting to the heart of how I understood ProducePay. The trading of produce is something that I'm still absorbing here, but the lending is the part that I knew best about ProducePay,
yeah,
which
it's not lending per se. What we do is we pre-buy a portion of their crop. So essentially we pre-buy their crop at a price, right? And by doing so, we allow them to essentially monetize the crop ahead of time. But we do this because we feel strongly enough in our models that we can say, yes, like I know that you will have 1,000 cases of blueberries, and I'm very comfortable giving you an advance of that $20 sales price of $12, because I just know you're going to have those blueberries, because my people that went there have given me the data. Our underwriting model has processed that data and is giving us a very high degree of certainty that you will produce those blueberries. So here's an advance over those $20 of $12 or $13, because I know for a fact you have a very high likelihood of growing those blues.
And in return, obviously, the percentage is going to be returned to you. We talked about between 2 and 12, but also in terms of the amount of production they have to deliver. Are you agreeing on a set amount and a set price at that point? And so both sides are sort of locked into a certain amount of delivery and a certain price? As
much as we can. Historically, to your point, because we've been in the financing nature more, or at least the underwriting nature, we tended to ride the market. But we try to do that less and less. Like in 2023, I went from being founder CEO to just being founder and executive director. And what that means in a whole bunch of words is that I wanted to spend more time in the farm and less time in the office, because I believe that to be the root of where I come from and what I think I can do best. But the biggest reason I did that is because I wanted to give the farmers not just the ability to essentially get capital for their crop, but also do it, as you asked, not just to lock in advance, because I can give you $10 if the market is going to be 20 or 30. I don't care about giving you $10 or $12 because I know the market, whatever it is, whether it's 20 or 30, will be big enough for me to get paid, right? But if you're a farmer, you care whether it's 20 or 30. So like my point is, I used to give them the ability to capture a part of their crop before. Well, we as ProducePay, now we're giving them the ability to do both, to capture a piece of a crop, but also tie in the price. And again, if the average will be 25 and you have 5 years at 20 where you lose, let's say $3, and 5 years at 30 where you'll make $7, like every book of business 101 will tell you it's better to have $25 every single year, because it allows you, like, you don't have to save, you don't have to keep the money in the years you have 30 and not save that money, which creates a cost because you have to keep it for the rainy days, right? You're just making your margin every year and you can invest it efficiently. So that's what we're trying to do.
Well, I mean, this sounds like a very cash intensive business, right? You have to have a lot of money to prepay for all this produce. And I know you've raised quite a bit of money. I don't think every round had been disclosed, but by my rough calculation, somewhere over $300 million raised for the company. Is that why you've had to raise so much? And if so, in this higher interest rate environment, does that make it tougher to do what you do?
The answer to both is yes. We've raised a lot of money because most of that money is used to, it's close to $500 million now, but most of that money is used to fund these farmers. And a lot of that funding is revolving, so we can actually turn that money 2 to 3 times every year. But yes, the rising cost of interest, it does make it more expensive. Now, we have historically been lucky that we closed a lot of our contracts before the interest rates rose, and only a small portion of those were variable rate. So for the first few months post rising interest, we actually became comparatively cheaper to the rest of the market. And to a big part, we still have that today. But yes, a lot of our contracts are up for renewal, and we will have to suffer those higher interest rates, which we'll have to find a way to then either share with the grower or ultimately pass down to some degree. That's why we're also moving very aggressively to the trading part of it, Tim, because if you think about it, if a farmer used to pay me 5 percentage points for my whole service, because let's say he used a bit of capital and a lot of trading, and I used to deliver a price point of him of, call it $22, or the industry did. And now I come back to him and say, you know what? I'm not going to be 5%, I'm going to be 7%, but I can guarantee you $25 from 22. The farmer's going to be like, I'll take that deal all day long because I'm paying a higher percentage, but I'm also getting a higher return. That's why our search for, call it, domain of securing offtake at a price and eliminating non-valid intermediaries is a way for us to bear those high interest costs or pass them to the grower at a higher percentage of take rate that we take, but provide a higher net outcome that makes the farmer better off. Now, most startups, what they'll tell you is the industries that are most primed for disruption are those that have a lot of non-value added intermediarism. So that's why we're going after these margins now, because we ultimately believe that that is where the value is that will allow the farmer to be better off, even if we have to do more for them and charge a higher take rate.
Sure. So being in between the market is one thing. You know, obviously buyers want lower prices and sellers want higher prices. That's somewhat straightforward to me relative to the other side of things, which are two things, the logistics and the quality. You know, where produce is very different from corn and soybeans is number 2 yellow corn is number 2 yellow corn no matter where you are in the world. Blueberries may be totally different. So does ProducePay manage all these logistics and making sure that the buyer gets the highest quality, most consistent supply exactly when they want it, and the seller doesn't have to, you know, kind of take all the risk themselves? Is ProducePay that one actually coordinating that? Because that sounds very difficult to me.
Yes, it is difficult, but yes, we coordinate it. Normally, retailers have a specific set of varieties they're willing to buy, or they buy different varieties of a certain crop at different quantities. They say, these are 10 qualified varieties of which I need 1 million cases a week. Talking to a big retailer. These are smaller niche varieties of which I need 200,000 cases a week. And then we would go out there and we would do it. Now, we've been lucky enough that our farmer partners are the best farmers in the world, right? Like, I'm not exaggerating one bit. Like, I'm not saying they're the top 1%, but they're definitely amongst the top 10% of farmers in the world. So what they do is they go to trade shows, they keep themselves informed. So we rarely, if ever, have to educate the farmers as to which varieties are the best. Most of them tend to have enough of an exposure to the market that they will keep themselves going in the new varieties. Now, sometimes they'll plant too much of a niche variety because it does sell for, call it $4 or more a box, but the market can only take so much of that niche variety because it's so expensive, and they overplant, and we say, I'm sorry, I can only take so much of that, yes, that does work, and we try to stabilize that. I mean, we see all of our farmers every month. Some farmers we see every week. Like we have what is likely the biggest like field operations team for a non-farming company. Like that's how much we want to be on the farm, right? So these feedback loops are continuous. But normally the farmers, they say, I'm going to have the best variety. So when we tell the supermarkets, hey, these are the varieties my farmers have, they'll be like, yep, no, yep, right? Because these varieties are just that good. That's also why, again, when I mentioned when we work with the small and medium farmers, it's not always about size. It's about doing things right. Like a medium-sized farmer that is willing to invest, even if it's with our capital, in the right varieties, even if they're newer and he has to spend more time like keeping himself relevant to what those varieties are, we work with them. But all the big farms today, they have to work with the new varieties. Otherwise, like they'll make themselves irrelevant.
Well, one of the things we've talked about a few times on the show in recent months has been kind of the change in the venture capital landscape, and you have sort of seen the complete hype cycle, I would say, of fintech. You know, right? Like fintech was like this word that nobody had heard of, and then it became this, you know, one of the hot areas of venture capital funding. And now it seems like maybe that's died down. You could tell me better than I could tell you. But can you talk about, you know, you all are the most probably quintessential example of fintech in agriculture, at least that I can think of. How would you describe, you know, fintech today, and what opportunities might still be ahead for fintech in agriculture?
Yeah, that's actually a very relevant question. And I was in the World Economic Forum last week. I was at the pleasure of being invited, as now food insecurity has become a much bigger and a much more pressing issue, especially as geopolitical tensions have risen. People want to make sure their country gets access to food, especially if they're worried that not everybody will get access to food, right? And I talked to venture investors there, and ironically, agtech is about to become much less popular than fintech was. So you're right, fintech was very hot, and then it got overhyped. So, you know, we actually started referring ourselves more as agtech than fintech, and then agtech got overhyped. And to be honest, a lot of the agtech companies, you know, again, I think we're one of the few lucky ones that have managed to actually quadruple their valuation during this time of low multiples, but a lot of them have done rounds. So agtech is a little bit beaten right now, but fintech has done surprisingly well in the years like post-pandemic, right? Because ultimately banks shuttered in the pandemic and they stayed back. So ultimately they create a vacuum of capital that fintechs, who were much more nimble, who were much more able to quickly jump into the new world of a post-pandemic world, actually got into. So fintechs have actually done, in general, very well in a post-pandemic world. So it's actually better for us to be a fintech than it is to be agtech in this day and age. And that was a tip that I actually got from a venture capital firm in Davos last week. They were like, sure, like you can say you're a fintech in agriculture. It's probably better than say you're an agtech today.
And I hear of similar companies trying to do somewhat similar things to you, as far as like really being an essential part of the supply chain. And what they're missing is that hook. And to me, what I see in ProducePay is that hook is, you know, the access to financing that wasn't available to a lot of these players before, at least not at the terms that you're willing to do that at. Would you say that's accurate? That's been sort of the hook?
Yes, our ability to successfully underwrite fresh fruit and vegetable perishable risk is one of the single strongest cornerstones that differentiates us. Yes. Now, to your point is, we've been around now for 10 years this year. You know, one of the reasons why it's been so hard for other companies to replicate us is not because of the financial acumen that we have. It's actually the contrary. It's because of the farming acumen that we have. And that is probably one of the biggest reasons, if not the biggest source of pride that I have, is that, as I mentioned at the beginning of our conversation, I come from a fourth-generation farming family. All I've ever known is produce, is fruits and vegetables. And I've always made it my mission that farmer-first mentality is maintained within the company. Because ProducePay did not learn how to underwrite fruits and vegetables by being a finance company that learned fruits and vegetables. We did it the other way around. We did it by being a farmer company that learned how to underwrite financial assets from the lens specifically and uniquely of a fresh produce company. So ultimately, it is our ability to stay a farmer-first company that has allowed us to keep that edge. And I'm hoping that we will always become one, even if we go public in the next few years or whatever kind of future, you know, the world has for us in the next years. I really wish that we will remain first and foremost a produce company or a farming company first.
Okay. No, that makes a lot of sense. No, I appreciate you clarifying that. Well, what's your role look like now? I know you mentioned, you brought in the CEO about a year ago. You wanted to get closer to the farm, but how has that been for you to understand, like, basically your role is probably like heart and soul of the company, I imagine, is part of it. But what does that look like day to day? How do you think about your role at ProducePay as founder, not CEO anymore?
It's changed significantly, right? First of all, I've gone from being Kirk to being Spock, right? Very different. Now I have a boss. Well, historically I had a board of bosses, but now I have a boss, and I'm no longer the final shot sayer. Now, I was very privileged for many reasons. One, the man, Pat McCullough, who is now leading the company, he was actually mentoring me for 2 years to be CEO. And then I just realized he was much better for the role than I was. And I literally begged him to take the role, and he has done remarkable. He grew more of the company in the last year than I did in the year prior, which is a very successful year. So that tells you how good it's been. But we're also very aligned. So we tend to be the yin and the yang in things. So it very rarely comes to a point where he has to make a decision. But if I know he feels a lot of conviction for something, I follow his lead. But he also respects my farming acumen. So in many ways, he's allowed me to become the farmer evangelizer that I think I always wanted to be. And I have deferred the ultimate business strategy to somebody that has run 2 public companies before, right? So it's different. I went from being a heart and soul farmer to becoming corporate CEO to now somewhat going back or regressing to being heart and soul farmer. So I personally love it. Like, I've never been happier in my life. Now, again, that's only because I have somebody in the captain's chair now that is an incredible captain, a much better captain than I could have ever honestly hoped to be. But I get to be the heart and soul of the company, which is honestly what I believe is my role, right? I get to see farmers firsthand, and farmers get to see that they're speaking to somebody, a founder, who is not just a suit or not just somebody trying to sell them, but somebody that actually shares on their pleas, shares on their needs, and honestly wants to do something that makes the industry better off. Like, I genuinely believe that my professional calling is not to be a serial entrepreneur. I became an entrepreneur because I wanted to change the industry. I had never heard the term startup entrepreneur or venture capital until I put ProducePay together and somebody told me, these are the things you need to do and call yourself to be able to raise money. But I consider it to be my professional calling to help digitize the industry. And sharing that passion with farmers is something that I believe they can resonate with, because you're not a farmer just because of business. Like, there's much lower risk mechanisms of achieving the same outcome. People that farm is because they feel passionate about feeding the world and doing it in a way where they can literally make people healthier, especially in fruits and vegetables. Like, I share that passion, and I want to share that passion. My goal in life is to see every major farming region in the world, which is a very ambitious goal, but I can already tell you that I've seen hundreds of them across different continents. But luckily, I'll be blessed with enough health to keep doing that. It's like that is why I've regressed to the farmer role to some degree, or the farmer founder role, but I very much love it. Like, I get up in the morning and I love it more than my last days as CEO, and I have nobody to thank but Pat McCullough, who has been a remarkable CEO and whose leadership now, I love being the Spock to his Kirk, if that makes sense.
It does. And I saw an interview with Pat where he said the goal was kind of deploying $2 billion in capital to farms in this year, which is quite a milestone, a lot of money, obviously. What else are you excited about for the future of ProducePay?
I am excited about building the first ever multi-annual fixed or preset price contract with a major retailer in the history, at least, of the Western world. Like, that is my goal, because that will be the first step in creating this exchange, this efficient market that we want to. Just in the same way that, the first thing I did was help underwrite asparagus and help collateralize asparagus, a perishable, like, collateral that we could get money 10 years ago. And that was the beginning of what is now a $2 billion funding year, like you were very well mentioned. This multi-year fixed price contract for a commodity will be the beginning of this exchange in the next, hopefully, 2 to 3 years, because our scaling rate obviously is faster now, given our rate of growth, right? So that's what gets me excited. Once we have those two things, the underwriting mechanism and the market offset mechanism, we will be the analog comparable of the Chicago Mercantile Exchange Board, but of produce. Like, that is literally what you do there.
I think that's a great place to end, Pablo. Thank you very much for doing this.
No, thank you, man.
All right, well, thank you once again to Pablo Borquez for being on the show. Really interesting concept, a big undertaking, but we like big ideas and big challenges here on the podcast. If you'd like to learn more about what they're doing, head over to their website, which is just ProducePay.com. And thank you again to Pablo for being on the show. Thanks as well to SwapMaps for being our quarterly presenting sponsor this quarter. Learn more about them over at swapmaps.com. And last but never least, thank you for your time and your attention. I do not take it lightly. I'll be back next week with another story of ag innovation.